Most traders don't fail because they lack skill. They fail because they misunderstand the game they're playing. In the markets, intelligence helps, but emotional balance sustains. We enter trading thinking it's about finding patterns, but we stay alive only when we learn how to manage ourselves. And that's where most of us stumble. Every year, thousands of traders begin their journey with energy and optimism. They study charts, devour strategy books, follow mentors, and simulate endless trades. Yet, as time passes, most of them vanish. The statistics are brutal. 90% of traders eventually lose their capital and quit. It's not because the market beats them. It's because they beat themselves. When I first studied Jesse Livermore, what struck me wasn't his intelligence. It was his understanding of human behavior under pressure. He knew that markets don't destroy people, reactions do. The urge to make back a loss, the rush to book a small profit, the temptation to increase size when things feel easy, these habits erode not just accounts, but discipline. Most traders think risk is about how much money they can lose. Livermore believed it was about how much control they could lose. A losing trade is recoverable, a broken mindset isn't. He used to say that the market's real toll is psychological, not financial. And that's why few survive it long enough to learn. In the beginning, every trader is full of hope. Then comes the grind, the small wins, the frustrating reversals, the near misses. Slowly, patterns form. Some traders get attached to quick profits, others chase the thrill of constant trading. And almost all ignore the quiet principle Livermore lived by. The biggest mistake is not losing. It's refusing to stop losing. As we move through this story, I want to explore why 90% fail, and how Livermore's philosophy exposes the subtle traps behind their behavior. This isn't about charts or setups, it's about rhythm, the internal tempo between risk and reward, patience and impulse. Every blown account, every painful mistake, every sleepless night comes down to one truth. You don't rise in markets by trading harder, you rise by trading smarter. Now, let's go deeper into the inner conflict that fuels this destruction. The paradox that makes even experienced traders repeat the same fatal cycle. The inner conflict, or market paradox. The deeper you go into trading, the more you realize the market isn't your real opponent, it's you. Every trade, every hesitation, every emotional swing reveals that the biggest paradox in trading is this. You have to take risks to win, but the more you need to win, the more recklessly you take risks. That's the loop most traders never escape. Jesse Livermore called it the psychological pendulum. He believed that traders swing between two emotional poles, fear and greed, and that most fail because they never learn how to stop the swing. When things go well, they grow overconfident, trading too often and too large. When things go badly, they shrink in fear, missing opportunities that could have redeemed them. The constant oscillation drains both confidence and capital. It's not the market's volatility that destroys them. It's their emotional volatility. A trader who wins 3 times in a row feels invincible. A trader who loses twice feels cursed. But neither condition reflects reality. The market doesn't care who you are, what you believe, or how hard you've worked. It rewards alignment, not emotion. Livermore often said that the hardest moment in a trader's career isn't when they lose money. It's when they lose objectivity. You can recover from a loss. But when ego takes over, when emotion clouds judgment, every decision becomes a gamble disguised as conviction. That's when traders stop following systems and start following feelings. This paradox deepens because the market reinforces it. Win once by breaking your rules, and you're rewarded with profit. A dangerous teacher. Lose by doing the right thing, and you're punished with doubt. Over time, traders begin trusting outcomes more than processes, emotions more than logic. That's how the 90% separate from the 10%. The successful minority doesn't feel less fear or greed, they simply act less on it. They understand that the market punishes impatience, not ignorance. Most traders quit because they can't tolerate boredom. They want movement, confirmation, and excitement. But Livermore understood that true professionalism often looks like stillness. The paradox is cruel but simple. The less you care about winning, the more you start to win. The more you chase control, the more you lose it. This is the inner tension every trader faces, and mastering it is what separates the emotional participant from the disciplined operator. Next, we'll explore how this inner conflict evolves into something even more dangerous. The psychological trap that keeps traders repeating the same losing behaviors, even when they know better. Every trader begins with optimism, but somewhere along the line they build invisible chains, habits and emotions that quietly sabotage their progress. This is the trap Jesse Livermore warned about. Knowing what to do, but failing to do it when it matters most. The problem isn't knowledge, it's control. In trading, your brain is wired to protect you from pain. The moment a trade moves against you, instinct tells you to act, to close early, to reverse, to add size in desperation. These are survival impulses, not strategic ones. Livermore understood this perfectly. He observed that traders often react to discomfort faster than to opportunity. The human mind, he said, is built for self-preservation, not speculation. This is why traders cut winners too early. The moment profit appears, fear of losing it kicks in. Conversely, when trades go bad, hope takes over. The refusal to realize a loss becomes stronger than the logic to prevent a bigger one. The cycle feeds itself. Fear shortens success, and hope prolongs failure. This psychological trap grows deeper because every loss erodes confidence. Once shaken, traders begin changing their approach constantly. New indicators, new mentors, new systems. Livermore called this method hopping, and he saw it as the death spiral of discipline. The trader stops refining and starts searching, forgetting that stability is the foundation of growth. Another trap is emotional anchoring. A trader remembers their biggest win and starts chasing it again, believing that replicating the feeling equals replicating success. But that memory blinds them to context. The market has changed, but their emotions haven't. They trade nostalgia, not data. Then comes the most destructive habit, overtrading. The need to always be in the market is disguised as dedication, but it's really avoidance. By staying busy, traders avoid confronting the discomfort of waiting. Livermore would often remind himself, the money is made by sitting, not trading. These traps are not technical. They're emotional. Each one eats away at clarity. Each one blurs the line between a professional approach and compulsive behavior. The cruel irony is that traders can see these mistakes in others, yet remain blind to them in themselves. Livermore's genius lay in seeing that trading wasn't about predicting the market, but predicting himself. He treated psychology as strategy, knowing that until a trader conquers emotion, no system will save them. Now that we've uncovered the invisible trap behind most traders' downfall, we can move toward Livermore's counterbalance, his philosophy for breaking free from this pattern and turning discipline into an edge. Livermore's perspective on the situation. Jesse Livermore saw trading as a mirror of human nature. To him, the market wasn't random chaos. It was organized emotion, a living chart of greed, fear, and impatience playing out in real time. He believed that every movement in price reflected a collective state of mind, and that by understanding human behavior, a trader could understand the market itself. Livermore's insight was that the market never truly changes because human nature doesn't. What worked in 1907 or 1929 still applies today, not in terms of tools or technology, but in terms of temperament. He would say that the ticker tape merely tells a story, but the ending depends on the trader's discipline, not the chart's direction. He divided traders into two kinds, those who trade emotions and those who trade behavior. The emotional trader reacts to every tick, every rumor, every rush of adrenaline. The behavioral trader observes those same movements but waits for structure, confirmation, and alignment before acting. Livermore belonged to the latter group. He didn't rush to predict. He waited for proof. When others were caught in euphoria, Livermore was watching for exhaustion. When panic took over, he was watching for stability. His method was built not on forecasting, but on patience. He believed that most of the market's profits were not earned through brilliance, but through restraint, the ability to wait until the odds were visibly in your favor. He often repeated that markets are designed to fool the majority. The reason so many fail is because they act on emotion before the move, while professionals act on confirmation after the move begins. This patience made Livermore's trading style look deceptively slow, but it allowed him to build massive positions at moments when others were still guessing. To Livermore, risk was never the enemy, impatience was. The market, he said, pays the patient and punishes the impulsive. His secret wasn't that he was right more often than others. It was that he lost less when he was wrong. By accepting that losses were part of the process, he prevented them from becoming psychological traps. Modern traders can see this mindset in action every day. The majority still trade headlines, emotions, and instant signals. The minority still wait, just as Livermore did, for clear, collective behavior to confirm opportunity. Livermore's entire philosophy can be summarized in one quiet truth. Trading success is not about predicting what others will do. It's about preparing for what they must do once their emotions take control. With that foundation in mind, let's explore how this perspective manifested in real life. The moments when Livermore applied these beliefs in actual market chaos and emerged with lessons that still define professional trading today. One of the clearest demonstrations of Livermore's philosophy came during the 1907 market panic. The world was in chaos, banks collapsing, stocks crashing, and fear spreading faster than information. Traders everywhere were reacting with desperation, yet Livermore did what seemed impossible at that moment. He stayed silent, calm, and observant. While others sold indiscriminately, he watched the tape. He wasn't watching for price. He was watching for behavior. He noticed that certain stocks, despite the carnage, began to resist further decline. He saw the panic slow, volume thin, and movement become erratic. To him, this wasn't noise. It was the first sign that the selling was exhausted. That subtle shift in character was his confirmation. He began to accumulate positions quietly, methodically, while the rest of Wall Street drowned in fear. When the market reversed, Livermore's timing appeared perfect. But what few realized was that his entry wasn't based on prediction. It was based on observation, patience, and psychological control. He let emotion burn itself out before committing capital. This event defined his approach for the rest of his life. He learned that every major market move, up or down, begins only when emotional extremes reach their peak. When traders can't take any more pain or can't resist any more greed, the reversal begins. Livermore mastered this rhythm, and it became the foundation of his fortune. He repeated this process in later years, including the 1929 crash, when he again bet against the crowd and profited massively. But for him, it wasn't about the money. It was about proof that discipline could outlast chaos. Even after these victories, Livermore never saw himself as invincible. He knew the market was bigger than any one trader, and that success today could become a trap tomorrow. His humility in the face of uncertainty was what kept his strategy alive. He didn't need to predict. He only needed to prepare. From those experiences, he crafted one of his most profound lessons, that trading mastery isn't built during rallies, but during drawdowns. How a trader behaves when the market turns against them reveals their true skill. Anyone can follow a system when it works. The professional stays composed when it doesn't. Despite his legendary career, Livermore faced devastating losses multiple times. The most painful weren't just financial, they were psychological. He once said that losing money hurts, but losing confidence destroys. After one particularly brutal period, he withdrew from trading altogether. The man who once commanded millions sat alone, reflecting on how emotion had once again breached his discipline. This was his turning point. Livermore realized that the market had not changed, he had. Complacency had crept in after success. Confidence had slowly turned into overconfidence, and overconfidence into carelessness. It's the same transformation every trader faces when a winning streak blinds them to risk. He understood that to rebuild, he had to restore not his capital, but his clarity. So he returned to his notebooks, reviewing every trade, every mistake, and every deviation from his principles. He found a simple truth. The market always offers information, but traders only hear what they want to believe. He had allowed ego to distort his interpretation of reality. From that realization came his renewal. He returned to the same fundamentals that had built his early success: patience, confirmation, emotional neutrality. His comeback was never about revenge or redemption. It was about restoring discipline. That's what made him different from the traders who disappeared after one major loss. This low point in Livermore's life symbolizes a universal truth. Markets don't destroy disciplined traders. They expose emotional ones. Pain, he discovered, wasn't punishment. It was purification. Each loss stripped away illusion until only truth remained. Livermore's breakthrough rule emerged from his hardest lessons. Never argue with the market. It doesn't care about your opinion, your conviction, or your prediction. It rewards those who listen. He built his trading around the concept of confirmation. Instead of guessing where prices would go, he waited for the market to reveal its direction. This meant patience, waiting until both price and volume confirmed the move. He learned that being early often meant being wrong, and that hesitation was often safer than impulse. Livermore also created strict personal rules. Never average down on a losing trade. Never double a position to recover a loss. Wait for the market to confirm your belief before acting. Take losses quickly, but let winners grow without interference. Trade only when the market itself invites you in. He believed these rules protected him from his own emotions. They turned trading into a system of response rather than prediction. To Livermore, the purpose of rules wasn't control over the market, it was control over himself. His greatest insight was that markets don't reward effort, they reward patience. The ability to wait for confirmation, even when your instincts scream to act, separates the professional from the participant. How it applies to modern traders. Livermore's lessons fit perfectly in today's world of screens, alerts, and instant information. The problem isn't lack of data, it's the overload of it. Traders today face the same emotions, but on a larger scale and at a faster pace. Modern traders are tempted by constant opportunity. Every signal feels urgent, every headline demands reaction. But Livermore's philosophy of confirmation reminds us that not trading is also a decision, often the most profitable one. The best trades appear not when you force them, but when the market aligns naturally with your plan. His ideas also translate to risk management. The modern equivalent of Livermore's patience is strategic waiting, entering only when multiple indicators agree, price structure confirms, and volatility supports your bias. The trader who waits for validation is no longer guessing. They're synchronizing with the market's rhythm. Emotional control is equally timeless. Livermore would say that technology doesn't change psychology. Whether you're trading from a ticker tape or a mobile app, fear and greed feel the same. His legacy teaches us that our greatest investment isn't in tools, it's in temperament. Define your structure. Create exact conditions that must be met before any trade. These include price confirmation, volume behavior, and contextual alignment with your system. Trade less, observe more. Livermore built his fortune by waiting for obvious opportunities. Spend more time reading behavior than reacting to it. Record everything. Journal your trades, emotions, and reasoning. Patterns of behavior reveal more than patterns on charts. Embrace losses. Early, small, quick losses are tuition. Big emotional losses are optional. Review periodically. Step back from the noise and assess your system with honesty. Adjust not for profit, but for consistency. Protect mental capital. Take breaks, reset, and detach after emotional sessions. Clarity must always come before capital. Livermore's method wasn't complex. It was disciplined simplicity, a rhythm built on observation, patience, and confirmation. The trader who follows it transforms chaos into order. The story of Jesse Livermore isn't just about wealth or fame. It's about endurance, the ability to survive yourself in a world that constantly tempts you to break discipline. His life proved that success in markets doesn't belong to the smartest, but to the most self-aware. Most traders fail not because they can't find the edge, but because they abandon it too soon. Livermore's rules remain eternal because they weren't written for a specific market. They were written for the human mind. He taught that every chart, every cycle, every rally, and every crash is a reflection of us. The market is neutral. We are not. In the end, Livermore's greatest victory wasn't in predicting the next move. It was in mastering the one inside himself. The trader's journey, at its core, isn't about money. It's about control, patience, and the quiet courage to do nothing until the time is right. If his philosophy can be summed up in one timeless sentence, it's this: the market rewards those who wait for proof and punishes those who demand it. Every trader faces the same test. Few pass it. But those who do, as Livermore proved, don't just survive, they endure.